The European debt crisis has hit the Eurozone hard, particularly the peripheral countries of Portugal, Italy, Greece, Spain as well as Ireland. Joining me now to discuss the current financial conditions of the PIIGS Economies is Christian Schulz, Senior Economist at Berenberg Bank in London. Christian, thank you very much for joining me. Now firstly, we've got a German vote tomorrow on aid to recapitalise Spanish banks, and EU leaders meet on Friday also to complete an agreement on Spain's bank bailout. Now this decision is still subject to a lot of controversy. Do you think everything will run smoothly this week?
A lot of questions will be left unanswered still, even after the vote in the German parliament and the final agreement probably. And the key questions that will be left unanswered are: will the bailouts retroactively next year, once the ECB has European banking supervision, be moved to direct recapitalization by the ESM? Will this happen retroactively? And the other major question will be, can senior bank bondholders share the pain and take some losses to simplify the intervention for taxpayers? But other than that, I'm quite optimistic that we will get a deal. The Finnish, which were quite critical, have secured some collateral from Spain, and the German parliament looks likely to approve the deal for Spain tomorrow.
Well, given Spain's current financial predicament and this 6 to 7% range for borrowing costs we're seeing, which is also considered unsustainable in the long term, how likely or unlikely would you say it is that the Spanish government is going to survive without further support and funding? Well,
Spain has been taking some measures to bring down its deficit, and luckily they also got a bit more time from Europe to do this, so that it's less likely that with too much cutting they will bring down the economy in the same way that Greece did. So the outlook for Spain is slightly better. The interest rates hover between 6 and 7%, which is a high interest rate, but by historical standards not very high for Spain and thus sustainable. It only becomes unsustainable if yields cross the 7% mark and a market panic sets in, where yields then start increasing very quickly. The situation has improved with a lot of compromising by European countries in terms of the conditions for a bailout, and thus Spain has all the cards still in their hands to make this program work and the reforms work, but they're walking a fine line.
What about the subject of Italy's solvency? The country has a multiple of economic problems, and investor concerns remain that Italy is also risking losing access to capital markets.
Well, the big problem for Italy is the level of its debt. Also, the recession that we've had so far was actually deeper in Italy than in Spain. However, Italy also has some strength. The Italian deficit was relatively low already last year, below 4%, and they've taken measures to bring down the deficit even further, so the debt dynamics are not as bad. The economy is much more diversified than in other southern European countries, and Italy is of course running a primary surplus, so they're not as dependent on capital markets as other countries. So overall we're optimistic that the adjustment recession in Italy will end towards the end of the year, and that the economy can return to growth, and once that happens, financial markets should also take heart, and the yields for Italy should continue to be below those of Spain.
Moving on to Greece, the country has already failed to meet a string of fiscal targets under its bailout plan, let alone future ones, and now Greece is fighting to secure a bridge loan to cover financing needs coming up. Now the country is already deep into recession due to crippling austerity. Realistically, Christian, how much further can it go on like this for Greece or even its money bank, the EU and the IMF?
In Greece, we are in the process at the moment of the new government establishing itself, dealing with the troika of the ECB, the EU and the IMF, which are visiting Athens at the moment to assess the progress or non-progress of the adjustment program. And then we'll have a period of renegotiation where the new Greek government is going to make proposals of how they would like to change the adjustment program. So there is a lot to do for Greece. Right now, I don't see much of a consistent and coherent proposal from the Greek government itself what exactly it wants to do, nor do we see the exact position of the Europeans. So there is a lot of uncertainty around. There's bound to be disappointment, especially on the Greek side, and then we'll see whether the government can really keep together its parliamentary majority as it votes through more and more austerity and structural reform measures. If it looks as though the government might break apart once again, I think the likelihood of Greece leaving the euro will once again increase.
How is Ireland faring at the moment? Ireland has been acknowledged for its success in implementing the painful austerity prescribed for it. But what else is being done to heal the economy without the fear of increasing its debt burden? And also, how now can Ireland start to convince capital markets to start buying Irish long-term debt by 2014 when the bailout programme runs out?
Well, Ireland has had massive economic problems, of course, going into this crisis. The major real estate bubble which burst, plus the government had to entertain a way oversized financial sector, had to take over a lot of the bank debt onto the public sector debt, which makes the numbers for Ireland look pretty bad. However, Ireland also has huge advantages over many of the other peripheral economies. It's a very open economy. Exports form more than 100% of GDP, so it's very dependent on external demand rather than domestic demand. And also the Irish economy is much more flexible. Labour laws are not as strict and rigid as in many southern European countries. So Ireland was much more prepared to do the adjustment program, and has succeeded in fulfilling all the targets and even doing better than some of the targets that the Troika set the country. So it looks quite likely that the Irish can return to the markets by the end of the year, and that will in turn be a good signal for the rest of the Eurozone, the struggling countries in the Eurozone, because if one country is successful, other countries, and Portugal is a good candidate, might be successful as well.
Well, moving on to discuss Portugal as the last candidate. Now, Portugal seems to be making progress in complying with the demands of its lenders in order to receive the latest tranche of its bailout. How successful do you think Portugal has been in its efforts to tame its deficits and reform its economy?
Well, Portugal is in many ways a mirror image of Ireland, but in really opposite in many ways. It did not have a real estate bubble. It did not have the kind of credit-fueled boom in consumption, and it did not have a very unstable financial sector. On the other hand, the Portuguese economy is not as competitive, by far not as competitive as the Irish one. There are deep structural problems, and the country needed a lot of reforms. But as in the case of Ireland, the government has taken ownership of the Troika program. It has fulfilled all the targets, done even better in many ways than what the Troika expected. But the problem of Portugal is, of course, that without the Eurozone crisis really being resolved or at least brought under control, it continues to be very difficult for to see how Portugal can return to the market. So Portugal might actually need more bridge loans, maybe towards the middle or end of next year when the current program.
Thank you very much, Christian. Some interesting comment there. We covered a lot. Now, I'm afraid that's all we have time for today, but stay tuned to Dukascopy TV for more financial news and Forex updates. Goodbye for now.